My name is Scott Barnett. For the last 35 years, I've been involved in tax, estate, and asset protection planning for individuals and the owners of closely held businesses. I started this after I finished my master's degree in tax law from New York University in 1973. Over the years, I've observed a lot about what goes on in the markets and a lot about where people want to put their money. Many people put it in bank CDs, certificates of deposit that are insured by the Federal Deposit Insurance Corporation, which is understandable. However, if they want to get a higher interest rate, they have to commit their money for 3, 4, or 5 years, which is also understandable. If you're looking for that more long-term investment to get the higher rates, there's an alternative that we can provide for you. One that gives you a higher rate of interest on a general basis. One that also gives you some very interesting tax benefits that you don't get from CDs, and also gives you some additional asset protection that CDs don't get you. First of all, the high interest rates are from companies that are regulated by the government and have reserves set aside that they have to keep set aside to meet their obligations to you. So in the commercial market, they're the most secure kind of instrument you can get. As or more interesting is the tax benefit you get. As you earn interest for the 3, 4, or 5 years, that interest is not taxed. It's deferred until you take the money out. So it's a tax-deferred investment that is better than the tax result you can get from getting interest in your CD. Another important feature is the interest that you get from this alternative investment is not going to impact or increase the amount of tax you would pay on your Social Security payments. Yes, when we get Social Security payments under certain conditions, those Social Security payments will be subject to income tax. Having this alternative investment is one of those situations where the interest it earns for the 3, 4, or 5 years is not included in what increases your tax on your Social Security benefits. So it has a double tax benefit. It defers the tax on the interest you will receive and can actually save you taxes on the tax you would otherwise pay for your Social Security payments. Lastly, this kind of investment in Florida, Texas, and a few other states that have this kind of statute, it is not subject to the claims of your creditors. If you have a lawsuit and you lose it, and the person with the judgment comes looking for your assets to satisfy the lawsuit judgment, they can get to your CDs. The guarantee from the government is only on whether or not the bank will fail. It does not protect you from your creditors. The kind of investment we're talking about, in those states where the statutes provide for it, in addition to the security you get because the company is regulated and has set aside reserves, you are protected from the claims of your creditors. They cannot come and get this asset. So for all those reasons, getting a higher rate of interest than you can get with CDs, having the double tax benefits of tax deferral on the interest, and also reducing the impact of taxes on your Social Security payments, and having a better asset for protection from the claims of your creditors, we have this alternative investment to tell you about. If you want to contact us to see if this is suitable for you, please fill out the contact information on the side of this video, and we'll be happy to get in touch with you and arrange a meeting for a consultation. I look forward to working with you. Thank you for listening, and we'll talk again soon, I hope.